Hey Tone, how are you?
All right, I'm good. I'm good. Let's hope this space works better. I'm actually not sure if Joe Carlasare will be joining. He never got back to my messages from yesterday. But price is definitely moving, so we'll have a lot to discuss.
100%. There's a lot that's happened today. Coming to look at things. Just give me 1 minute, Tone. All right. Hi guys. Sorry for the delayed start from my side. How's everyone doing? Welcome to the Financial Summit Spaces. Today we'll be talking a lot about Bitcoin. A lot has happened in Bitcoin. So Tone, before I start off, what's really going on? We are seeing a massive candle in Bitcoin. Any thoughts on it? What do you think is price trying to do here? You're muted, Tone.
Yeah, no, I have to just get back to the app. So there's a massive sell-off going on in GBTC, as I've been talking about this for several days now, because I realized it fairly quickly because I did the same thing, sold my GBTC in order to enter, a better Bitcoin proxy. And I think at this phase, GBTC might actually die as a product. But before it dies, it will end up selling over 600,000 Bitcoin. Now, that is a massive amount of Bitcoin. And I highly doubt that GBTC was anticipating that there would be such a mass exodus. Most of these other ETF companies anticipated they were going to be buying a lot of Bitcoin, and they probably went into deals with lots of OTC dealers and exchanges in order to buy this much Bitcoin. GBTC, however, is a grossly irresponsible product led by horrendous CEOs, and I'm sure they were not ready for this. And I believe that they are selling this Bitcoin on the open spot markets, driving the price of Bitcoin lower instead of setting up proper deals with OTC dealers. And I think this whole thing caught them by surprise. And saw the news today that FTX is selling like $1 billion worth of Bitcoin, which actually is not, as much as you think. I mean, GBTC is sitting on what, 20, 30 billion dollars more, maybe? I got to check. I actually have my own spreadsheet that I maintain. GBTC is sitting on $22.5 billion worth of Bitcoin. So if FTX is selling 1 billion of that, GBTC might be selling that in the spot markets, and there's just not enough demand in the spot markets, hence driving the price lower. And this is what people don't understand. And I've been saying this for a long time. The spot ETF is a double-edged sword. It's incredible in a bull market, but in a bear market, it puts additional selling pressure of the Bitcoin. No one, everyone had, these rainbows in their eyes, and no one wanted to even think about the potential threat that a spot ETF brings in a bear market when the ETF itself is selling more Bitcoin than the market can absorb. Now, everyone thought that once these spot ETFs show up, everyone and their mother and their grandmother will instantly go and start buying into these ETFs, and it would only bring buying pressure into the market. But clearly, the amount of people exiting the Grayscale ETF is even higher than the buying pressure entering these other ETF markets. Awesome. I see Joe Carlasare has joined. That's amazing. So I'm keeping track of this daily in my own spreadsheet. And on Friday, according to my personal track, because other people are doing this and everyone kind of has their own data. I don't know what others are getting their data. Some people are putting the data on different days. I like to do my own data. I'm doing my own due diligence. According to my work, only 45 extra Bitcoin were bought across the 10 ETFs versus the amount of Bitcoin sold by GBTC. And if GBTC is selling that Bitcoin on spot, and these other ETFs are mostly buying this Bitcoin in OTC, this completely explains the massive drop in the price of Bitcoin. In addition, lots of shitcoiners exited their shitcoins to enter Bitcoin. We saw this. We saw Bitcoin grossly outperform the shitcoins earlier, in December, in November, December, going into January. We've seen altcoins significantly outperform Bitcoin since the start of the ETF. So that is not helping Bitcoin at all. And finally, besides the shitcoiners, people that were interested in Bitcoin were pre-running the amazing great news of the SEC announcing the Bitcoin ETFs. And there was just nobody left to buy. Everyone that was speculating on Bitcoin rising did it before the ETF. And this is why major bullish news tend to become selling events, because there's just nobody left to buy. Everyone was already in. So the only people that are left are sellers. There's not enough buyers coming in. And once the prices start going down, everyone waits for the perfect dip. Now, I've been calling for the perfect dip to take place at 36,000. But if this thing keeps going down all the way to 30, I would not be surprised at all. But to me, between 36 and 38 was the buy the dip area. I exited 75% of my bullish position in Bitcoin the day before the ETF came out, just based on everything I just said, which I anticipated was going to happen. And here we are. So no surprise on this end, but some people seem to still be very, very confused as to what's going on. Joe, would love to hear your thoughts. Not sure if you were there for the very beginning of me talking about what I think.
I have something to ask Joe as well, like after he can give his thoughts. So Joe, please go ahead. Your thoughts on what's happening with the price action. We are seeing back-to-back days. Like obviously yesterday was green, but it was Sunday. But we are seeing very, very bearish price action in the last 1 week or so. What's your thought on it?
Yeah, thanks for having me up. So I think what Tone hit on, and I didn't hear the beginning, but what Tone hit on at the very end of his remarks there is spot on. This is very typical in markets. This is why you have the adage of, buy the rumor, sell the news, because human beings anticipate and position based on the hype, the FOMO, based on their peak optimism, and at that point there's very little buyers left. So the notion that there were going to be major pools of capital that would wait until the actual launch of the ETF to start buying seems like a fantasy to me. Even if you're somewhat sophisticated, right, and you wanted to hedge, you could have easily put on that hedge prior to the actual launch of the ETFs with futures positions. And big money, smart money, whatever you want to call it, it's not stupid. They were not going to wait and pile in the days that followed, particularly when they recognized something that we've talked about on this very program multiple times, that the way to close the GBTC discount is for Grayscale to sell. That's the only way you close the discount. That's why the discount exists, because of the Hotel California structure of the GBTC trust. Prior to the conversion to the ETF structure, they were not able to sell and are about that discount. So, from my perspective, I think this was fully anticipated. I don't think this tells you anything at all structurally about where the market is heading, 5 months, 6 months, a year from now. I think it was well overdue for a correction. In fact, I tweeted out over 60 days ago that I didn't think there was going to be any correction until the ETF launch, because of this exact reason. Who is a big seller of Bitcoin would sell unless they were really smart and really savvy with markets in advance of the launch? No, you wait until the last minute, wait until you've reached peak FOMO, peak optimism, people talking about 100K before the halving. And then that's when you sell. You sell into those people that are, panicking and capitulating to the upside because they didn't get a big enough position all of last year when they could have, acquired Bitcoin at much lower rates. So for me, I don't think there's very much of this recent price action. I think that the Grayscale selling is not even the primary factor. I think it's traders that have been trading around this, and it's the Grayscale selling is a factor, no doubt. But if you look at the actual flows, there is a slightly negative net flow or slightly positive net flow into the ETF structure, meaning that just look at Bitcoin held by the ETFs. The Bitcoin held by the ETFs today is more than the Bitcoin held by GBTC prior to the launch of the ETFs, meaning on a net basis, the ETFs hold more Bitcoin collectively than they did previously. Now you get some friction because of some of the selling, which, I guess that can cause some pressure, and it can liquidate people, and that can, because there's so much leverage in the Bitcoin space, and particularly with the offshore derivatives markets, that can cause a big cascade. I mean, that's what I think the price action is seeing right now. But for people to get all bared up here, I don't really see it. I don't see a reason why. I do think you're in for a period of consolidation, because you had an epic run, very fast run over the last several months, and really the last 6 months. So to me, let's just deal with it. Put on positions. If you want to try and grab bottoms with coins a little bit lower than here when it goes down, do that. I'm not taking that position. I think this is an unbelievable opportunity to add going into what I expect to be much higher Bitcoin prices at the latter end of this year.
Yeah, let me just jump in, since you didn't hear the beginning of what I said, but that is what I said, only I did give it a little more credence, right? So in general, every single day, there was more Bitcoin bought by the other ETFs versus Grayscale selling. However, to me, it matters a lot how that Bitcoin is being bought and how that Bitcoin is being sold. These other institutions, I'm pretty sure, set up deals with brokers and miners and others for OTC buying of this Bitcoin. They also could have set up futures contracts in order to absorb the Bitcoin without significantly raising the price of Bitcoin. Because again, we are dealing with smart money here. Now, the people that run Grayscale is not smart money. If they were, they wouldn't have gotten themselves into the Genesis debacle and all this other nonsense. They wouldn't be firing their CEO last minute. They're not as sophisticated as the rest of these ETFs. So I am not surprised that they did not have any kind of proper structure to sell this massive amount of Bitcoin that they've been selling. On Friday, they sold 14,000 Bitcoin. On Thursday, 10,000. On last Wednesday, they're almost 14,000. And I think a shit ton of that Bitcoin is being sold on the spot market, hence driving the price of Bitcoin lower. Instead of having proper deals in place, even with these other ETFs, for them to buy it from them. But I don't think they set up those deals.
Tone, you're trying to say this is all about mismanagement or no sense of understanding of what's to come from GBTC side.
Well, not all.
Hold on.
Not all, but I think GBTC mismanagement is somewhat to do with it. But again, it's not the only reason. The main reason is probably what Joe and I talked about. There was nobody left to absorb and buy other than the ETFs themselves. And I also mentioned that the shitcoin rotation into Bitcoin in preparation of the ETF and out of Bitcoin back into shitcoins is also not helping. So all three of these reasons, in any order you like to put them, are contributing to these drops. Go ahead, Joe.
Well, no, what I was going to say is the one thing that I think people should get some clarity on is when you were talking about agreements between the ETFs, between Grayscale and other entities. Structurally, that's really hard to actually accomplish because the way the ETFs are constructed is with authorized participants. And those authorized participants have preferences as to how they acquire Bitcoin, whether through OTC or what my understanding is most of them are going into the spot market. And also they're going into the spot market days removed from the actual inflows in terms of cash creates into the ETF. So in other words, they're not front running a lot of their purchases as I think people think they are. The way it's actually working is they're getting the cash. The cash goes to the authorized participant. The authorized participant does a little bit of forecasting, but not as much as you would think, and then goes and acquires the Bitcoin. So, for example, if you knew definitively you're going to have X amount of cash flows into the ETF, you could possibly do what you're I think implying, which is cut some sort of OTC type deal with Grayscale. But then again, you have to offset that because Grayscale is dealing with outflows from their vehicle. So it's very difficult to forecast. And when you have a market as young relative to other more liquid markets like, SPOs or, NASDAQ, it becomes hard in the short run to absorb that sort of influx in sales of Bitcoin. And they're not hedging with as many futures contracts as perhaps they should. That's a legitimate, issue. They could easily hedge that with futures contracts. But, to me, again, like I think all this gets sorted out. I don't think it's some sort of significant, message about the lack of demand for these products. And I also I don't necessarily think it's. I did catch a little bit of the, the negatives of the ETF. I think that's overblown, because at the end of the day, the ETFs, unlike the GBTC, which is far more negative prior to the conversion, because of its Hotel California structure, they're going to be selling and buying with the spot market on a routine, regular basis. So you're not going to get these wild swings where they're sitting on a ton of Bitcoin at a premium, or they're sitting on a ton of Bitcoin at a discount. That's not going to happen. It's going to be a much more steady sort of flows in and out of the ETF, which to me will add to the robustness of a bull market.
So Joe,
go
on.
No, it's okay. I was gonna just say I'm not in full disagree. It's not a big disagreement, but my view is, Joe, that these ETFs anticipated a big influx of cash to purchase Bitcoin. And I'm not saying they made specific deals because they don't know how much cash they're going to have. But if you're going to have significant cash coming in to buy Bitcoin, they could have had, certain arrangements within certain, for certain, let's say, tranches of Bitcoins from certain large holders of Bitcoin. And they could have, set up these arrangements with specific OTC professionals in several months prior. I highly doubt that Grayscale's professionals, if you like to call them that, set up similar arrangements on their massive exits. And
go on.
I'm sorry, real quick. And on the what was that other topic that you were saying at the end? On the GBTC thing. So yes and no, right? I just think of it differently. The wild swings that GBTC was having, because it's that Hotel California, it was only benefiting the underlying spot of Bitcoin in a bull market, but it was not negatively affecting the spot of Bitcoin in a bear market because there was no mechanism to sell the Bitcoin. So to me, GBTC actually did not cause wild swings. The wild swings were only for GBTC hodlers, not for all the Bitcoiners, right? And GBTC hodlers is a subset.
No, that's not true, though. But that's not true, because what it did is it created artificial buying pressure in the bull market. In other words, you probably would not have gotten to 69K had you not had Grayscale and like drunken sailors buying into the fall of 2021, which is what they were doing. They were buying Bitcoin at prices above, $50,000, in very steady clip. So that exhausted you more to the upside, and like a rubber band, if you stretch too far to the upside, it snaps back, and then you have a hangover to the downside. So I think it contributes on a net basis to unnecessary volatility in the space.
Yeah, maybe. I do look at it from more like the result. Like, had GBTC was approved to be a spot ETF in, say, 2022, the price of Bitcoin would have fallen way below 15. Probably would have gotten to like 9 with all the GBTC selling to the downside. But because they couldn't sell, the price didn't go lower than 15 on FTX.
So, Joe and Tone, like for both of you, so obviously we have talked about GBTC doing what they are doing, but it's been more than a week, I think, since the kind of, since last launch or launched last week. I mean, we have seen a decline of around 18 to 19% in the BlackRock iShares Bitcoin ETF as well, while the underlying asset has declined less than half of that. For our listeners, why is that so? Like, why is the price of the underlying asset not dropping as much as the ETFs in themselves? Is it due to the volume or something else is happening there?
I think they're dropping exactly the same. I think the percent fall in Bitcoin is identical to the percent fall of the ETF. That's literally why it's a spot ETF. I don't follow why the ETFs would fall more, and I don't believe that they have. I don't.
I have the chart with me. I'll share the chart with you if I can. Let me try to find the tweet.
Well, just
as
while
well.
you're looking up the exact numbers, I don't know them off the top of my head.
I'll put the tweet in the nest so that
yeah,
it's visible to you guys. One
well,
second.
if
Should
it's
have done
within
this before.
100 basis points, right? That's not a significant distinction. I mean, I still think Grayscale's technically trading at like a 40 bip discount to NAV. They're trying to close that, and that's what's contributing to more of the selling. But that takes time, and to me, like anything inside of 100 bips is kind of de minimis. I wouldn't read too much into that.
Right, and also don't forget, like Bitcoin trades in a 24/7 market, and the ETFs only trade 7 hours a day. So, for example, right now, if I look at my ETF list on TradingView, my list, Bitcoin for the day is down 3.5%, and all the ETFs are down between 3.5% and 4%. Franklin Templeton is down the most at 4%. Everything else between 3.5% and 4%. But that 3.5% for Bitcoin is kind of factors in that a bunch of more hours. So they're not going to be perfectly in sync, but they're going to be pretty in line. And when a week is all said and done, it's going to be about the same.
That's for the listener. So like people have been asking us about this on the Discord as well. So I was like, okay, I'm going to ask it in the space. So you just mentioned, Tone, that the Bitcoin ETFs are trading 7 hours a day, and obviously they are closed over the weekends. And let's go down to the futures market a little. For the Bitcoin future ETF, CME futures, there was a CME gap from the 1st of December week ending 1st of December, where the price is right now. It's literally trading inside of it. Now, we all are assuming Bitcoin's going to go to 36K, worst case scenarios, 30K, and maybe further down, whatever happens. But from the perspective of the gap, once the gap is filled, obviously we know how technical analysis work, and we say that, okay, if a breakaway gap is filled, the price can reverse from there. Do you think this point at which the price is trading right now is a crucial point in regards of that? You're on mute, Tone.
Sorry, I was looking at that chart that was posted. Let me just get back to that real quick. I don't like that chart at all. That chart is completely misleading. You can't use like the first second of the ETF launched because just like with an IPO, the first few trades are so illiquid. Basically, if you redo the ETF chart, if you compare the IBIT ETF to the Bitcoin ETF, but you don't start with the very first trade, but you start, let's say, 3 or 4 hours into the first trading day, or maybe even better, start on the second trading day where the market already had a little bit of liquidity, you will see that they are down almost exactly the same thing. Honestly, I think the very first trade of the ETF distorts everything. That's just my guess on that chart, but it's a sensationally looking chart. It's just completely incorrect. I don't know what Joe thinks the chart is in the nest. It's the most recent chart. And while Joe looks at that, I don't really care about the CME gaps. They are completely irrelevant to me. Again, the CME is not the price discovery of Bitcoin. The price discovery of Bitcoin is on the spot markets. And what happens on the spot markets matters. Now, when the CME becomes the price discovery of Bitcoin, like the gold CME future or the oil CME future, I will then potentially start taking the CME gaps relevant because most of the time, I only take a gap relevant for a short amount of time. To me, a gap in the stock market only matters for like the day of the gap. When a stock gaps, it has a high probability of closing the gap within the same trading candle. If it doesn't close the gap within the same trading candle, the probability of closing that gap ever for the next 30 years is actually probably lower than 50%. So if the gap isn't closed within the candle that caused the gap, I completely ignore the gaps into the future. Some people care about them, but I personally don't.
No, that's fine. I love gaps. Positively, it's good to trade with. Sometimes, at least in the stock market, it works very well. Okay, moving on, Tone. Again, we are sticking to Bitcoin for at least a few more minutes. Now, GBTC, as you guys have mentioned, are already selling, and their pace is around about 400 million a day, closer to that mark. How do you see the space going into the next week or this week? How do you see it progressing? Are they going to slow down the selling pressure? Is the selling pressure going to go away, or is it going to keep? They're going to keep selling at a sustained rate. So Joe and Tone, both of you, please
Yeah,
feel
let
free
me
to.
go with it first. And I'll give you the honest answer. Nobody knows, right? The answer is nobody knows. Okay, everybody can think they know, but you have to look at the fundamental factors that are driving the selling. What are the fundamental factors? Let's go through that because that's helpful for people. One of the fundamental factors is the discount. Okay, the GBTC has to sell spot Bitcoin to arb out the discount. We've covered that. That's self-explanatory. I'm not going to waste time on that. What's another factor? There are factors with some of the bankruptcy proceedings, which are now taking the opportunity here with higher Bitcoin prices to liquidate GBTC shares. Now, how does an ETF function? An ETF functions when the sale of the shares occurs. Eventually, the entity has to sell the underlying assets they hold to move the shares closer to NAV, right? So selling of the shares, not on an instant basis, but over the period of several days, will result in the sale of Bitcoin. So if people continue to sell their shares and flee the GBTC, either because they want to liquidate shares to pay out bankruptcy claim, or because they want to move to other ETF structures like IBIT or other mainstream Fidelity ETFs, whatever, that's going to result in more sales of GBTC, which will result in more sales of Bitcoin, which will drive it down further. But then who knows? I mean, if theoretically, GBTC could have to sell off every single Bitcoin that they hold if people continue to flee the trust. I don't believe that's going to occur. I don't think they're going to end up with zero Bitcoin on there. But could they lose 25% more of their Bitcoin holdings as people flee for other structures because they don't want to pay the fee? Absolutely. There's nothing to say that it won't do that. But you got to remember, there's a difference between a fundamental factor driving it down and people's preference for other exposures to Bitcoin is to driving this price action. And to me, that's what you see here. I think it's primarily driven by the bankruptcy cases, some forced liquidations of GBTC shares in that respect, as well as the discount, and some, let's just estimate it between 10 to 20% of preference for other vehicles that are not Grayscale. I mean, think about it. If you could pay for a world-class entity like iShares, BlackRock, to have your Bitcoin versus Grayscale, who is, by the way, currently being sued by the New York Attorney General, and there are whispers of criminal charges as well, why would you want to mess around with that entity? So to me, it's an easy sort of deconstruction of what the problem is. The problem is Grayscale specific, and unfortunately, because of their outsized effect on the Bitcoin spot price, because they used to hold 600,000 Bitcoin, you're going to feel it. And our market is too young with not enough buy side liquidity at any given point to absorb huge amounts of Bitcoin being sold off without buyers on the other side to gobble them up in the near term. So so that's the right answer. Nobody knows.
Tone, do you agree or disagree with that point?
So what was the exact question?
That the GBTC selling pressure, will it reduce? And if so, in the coming weeks, what can we expect?
Again, I'm with Joe on this one. I think it will, I think it will even out eventually. I think once the price of Bitcoin drops to a certain level, to me, that level is around 36, more buyers will step up. A lot of people are just waiting to buy the dip. And most people are smart enough not to buy the dip until the price actually starts to reverse. It may not reverse until it gets to 30, but GBTC is putting on pressure and there's just not enough buyers stepping up. But as the price goes lower, hell, Michael Saylor might take a big swing at this. Another big company might take a big swing. I think there's lots of companies out there waiting for the price of Bitcoin to be lower before they step up. So they can stop the slide anytime. As a technical analyst, this is what I'm looking for right now. From a fundamental perspective, I have no idea. I have no idea if tomorrow GBTC is going to be selling more shares than all the other ETFs are buying, because that's what the trend is like. But from a TA perspective, I have amazing support at starting at 38, going all the way through 36, plus an MRI buy on the MRI indicator 3 days from now. So around Thursday, there will be an MRI buy. Now, if that MRI buy comes in the vicinity of 38 or lower, I'm going to be even more willing to try to catch the falling knife and buy the dip. If the MRI buy comes in at current price, I'm not going to be as eager because it hasn't hit my low targets yet for the perfect buy the dip scenario. But if we start to reverse and the price of Bitcoin starts going above, say, 43,000, I'm a buyer once again. And by the way, while Joe was answering, I took a proper look at what the how much Bitcoin fell versus how much the ETF of BlackRock fell. And I did a proper comparison, not bar charts, who clearly don't know what they're doing. I started looking at exactly 4 p.m. on Thursday, the 11th. So at the moment of the close, as of 4 p.m. on the 11th until right now, they lost exactly the same amount of money, about 13% on both of them.
That's great.
Yeah. So the first day of trading, I believe, was the 11th. But I started my comparison as of the close that day. So from the moment the market closed, from the first day close, they were and in fact, I think Bitcoin lost more money than the ETF since that moment, a little bit more.
Well, I'll put a comment down there for them to know that. Thank you so much, Tone, for looking into it.
I'll actually, we can reply to it. I'm going to do an even proper comparison. I'm going to take it to maybe 11 a.m. or something like that. Like, you got to do it by the hour. Maybe start like on the second or third hour of trading, or maybe 11 a.m. Start at like 11 a.m., give it the first hour and a half. And then from there, I almost guarantee you they lost the exact same amount of money.
That's good to know. Well, they did it for the clicks, I guess. So let's move on from Bitcoin a little bit towards a bigger crypto scenario. Basically, not crypto, to be honest. Let's move on towards our favorite topic, SEC. So, Joe, this is your domain. Binance versus SEC. CEO and co-founder CZ and the exchange are being charged for the following things: artificially inflating its trading volumes, diverting customer funds, failing to restrict US customer from its platform, misleading investors, and facilitating trading of several crypto tokens that SEC deemed unregistered securities. That's what's come from Routers. Joe, what's going on there? Is there anything new, or is it just old story going on again?
Well, I think it's more of the same, largely from the suit that was filed in the Coinbase action. In fact, many of the allegations are copy and paste with respect to Binance operating an unregistered exchange, unregistered broker-dealer activities, and unregistered clearinghouse. You have numerous tokens listed in the complaint. Some are different from the Coinbase tokens, most notably the BNB token, which the SEC, unlike the position they took in the Coinbase action, claims that Binance itself is in and of itself a security, the BNB token. So that's sort of a distinction, and that coupled with some of the staking activities. The big real distinction, I think, overall in the two cases is the allegation that Binance had some of these prop in-house trading accounts trading against their customers. You don't really see a lot of that in the Coinbase suit itself, but many of the other portions of the claims are virtually identical. So, I'm sure at this level they have coordination between the two um, teams of lawyers that are leading both the Binance suit and the Coinbase suit. There's very little doubt in my mind that they've strategized to make sure that they're arguing um, similar theories of law in both of the cases. And you got to remember that one of the reasons why I think they did it in this way, where they filed several suits in several different forums. You got to add in also the Kraken suit, which is still pending and has very similar theories, is that what they're hoping occurs is that they get at least one or two of these courts of the three to agree with the SEC's theory. And if you get one or two of these to agree in court, notwithstanding the suits where they may lose and the rulings like in Ripple Labs case, what the idea is, you want to get to the appellate court, you want to get to the Court of Appeals rather, where you have sort of a split among the district level courts. This is very typical of what occurs in new and novel areas of the law. You get judges in different states seeing issues differently. You've got them coming down in different ways, and that's part of the process. Part of the process is to encourage an appellate court that this is an issue they have to look at with a sober mindset and not get too persuaded that it is something that is well defined and well developed. And if you listen to the Coinbase the judge presiding over the Coinbase suit, what she made a comment on the record, which I think was telling, is that she said, look, these are tough issues. These are issues without a lot of precedent. There are esteemed jurists on all ends that can disagree on these things, and we need to carve out some sort of rule that has a limiting principle. I know you asked about the Binance case, but in the Coinbase suit, it was really instructive to me that the judge was struggling most off with this notion that, look, I don't want to open the door to this idea that any and all collectibles and trading cards and beanie babies and all these things could be investment contracts under the right circumstances. I need limiting principles where I can easily distinguish between collectibles and things people buy, maybe with some expectation of value, but something that can let me distinguish between that and perhaps tokens, where there is some degree of separation between the issuer and the buyer, right? The judge was focused on in so much in those oral arguments about, well, when you're going on Coinbase, you're going on this platform, you don't know if you're buying it directly from the issuer. You're buying it on a secondary market. And what is that? Is there really a promise? Is there a contract or some sort of a privity of agreement with the issuer and the actual purchaser? Does somebody who's buying a token like Solana on Coinbase, are they really entering into a legal agreement, a contract with the actual issuer? So that's what the judge is grappling with. And in the Binance suit, I expect that judge similarly will be dealing with some of the same issues. And my personal view is that you're going to get, on these motions to dismiss, you're going to get split decisions. You're going to get the court to rule in favor of Coinbase on some of the issues, and you're going to get them to rule in favor of the SEC on the other issues and say this needs to go for discovery, and it's going to take a long process, perhaps well over a year before you get some sort of resolution in these cases.
But one thing that really came out was the SEC's statement about when it was the Coinbase case, where they said that the token itself is not a security. But in case of Binance, they're saying that the token itself is a security. What is the major difference here?
Hold on. That's not 100% correct. Okay, let me explain. So what Coinbase's own counsel conceded, and I tweeted this out in real time because I took notes on the hearing. Coinbase's own counsel made a tactical decision saying that we don't believe any of the tokens specifically listed in the suit are in and of themselves investment contracts. That was what they said. However, the Coinbase's counsel was willing to concede that theoretically a token could be in and of itself an investment contract. Now that's really important because they weren't arguing for what we call in the law a bright line rule that in any and all circumstances a token can never be an investment contract. That was smart from a strategic standpoint because you could clearly envision circumstances where that would occur. Think about if I'm Apple, and I want to just issue tokens that represent shares of stock, that would be those tokens in and of themselves would be securities. That'd be a very easy way. No court of law would adopt that broad of a rule that tokens just on their face cannot be securities. So they made a tactical decision to say, no, that's not what we're saying. We're just saying that these specific ones are not investment contracts. Well, that's kind of rich in my mind because you have to remember one of the tokens at issue in the Coinbase suit that was purposely named out of all the ones on their platform was the VGX token, which I don't know how familiar you are with that token, but that was one of these tokens that was aligned with the Voyager platform, where you had special rights based on how profitable Voyager was as an entity, and they paid yield on it, and it was controlled by Voyager and controlled by the supply. To me, like that's probably one of the closest to the investment contract that's out there, combined with the BNB token, which Binance. I think that's how that exchange stayed afloat for as long as it has, most of the BNB token. So to me, like those are much closer calls, and I think it's going to be difficult for the judge in context of motion to dismiss to rule on those issues. Even in the Ripple Labs case, they got discovery and they went and looked at, what are the exact circumstances and scheme of this launch, and it wasn't resolved on the pleadings, which is effectively what a motion to dismiss is. But to answer your question, Coinbase did not take the position that a token in and of itself cannot be a security, just that those particular tokens weren't not.
All right, so nothing major. It's still the same. That's the main thing. And obviously, thanks for clarifying that small bit that I was confused about.
Yeah. So the way to think about this is that when you file a suit, okay, any litigation, any civil litigation, certainly, there are a variety of different theories and torts and claims and contract claims that are generally put forward. And the judge is supposed to conduct what's a preliminary review at the outset on a motion to dismiss. And what the judge is supposed to look at is, are there factual issues with which we need to assess through the lens of discovery? Now, good lawyers never want to subject their clients to discovery because that's very onerous. It takes a lot of time, it takes a lot of expense. So, what most lawyers try to do is they try to knock out or at least pare back the claims at issue in a motion to dismiss. So that's what we have going on right here. Now, what people confuse, and a lot of the Twitter lawyers that are talking about this, or armchair lawyers, they mistake the fact that motions to dismiss are not typically on the merits of the case. They're typically trying to, sort of say, let's look at the entire complaint in the light most favorable to the SEC in this case. Let's look at every inference in favor of the SEC. And if we do that, is there any legal basis for the SEC's claim? So in other words, it's a very deferential standard. It's a standard with which the vast majority of cases get to go forward to discovery. And it, in fact, is a huge win if you're in my world and you get a case dismissed on a motion to dismiss. Most cases either settle or are resolved on motions for summary judgment, which is after the close of discovery. If you look at Ripple, okay, for example, the Ripple case, which we've talked about a lot in these rooms, Ripple, the big ruling we got, that was in the context of a motion for summary judgment after a year or more of discovery where they went through all the different issues. So, the judge may deny the motion to dismiss and may eventually rule in favor of Coinbase, a year or so down the line. So you really can't read too much into it at this stage if the judge allows the case to move forward. Even in Ripple Labs, the judge allowed the case to move forward, and actually the SEC won the motion to dismiss that was filed by Ripple Labs. People forget about that.
So Joe, I've just put a tweet in the nest from you regarding the ratio charts. And I saw this tweet today. Basically, I was just going through Twitter and saw it. And I've been looking at some of the BTC ratio charts as well, trying to find opportunities and see whether there's something which can be done in terms of rotation. What are you trying to tell with this chart, BTC USD versus NVIDIA? What are you trying to convey, and what is it you're trying to push it out.
Okay, so you're asking about the chart?
uh, about the chart, about
Yeah,
the ratio charts as well, about the S&P, because if we look at
yeah,
the overall picture, there is a very, very big uncorrelated nature of the market right now between not just the tech sector, but the stock market and Bitcoin as well. Like stock market is creating new all-time highs where Bitcoin is not even, anywhere near it right now. It's at 50% Fib level most likely. So what can we take from these charts?
yeah. I don't think you can take a whole lot from them. I think what is interesting to me is that there tends to be periods in which risk assets, and I know Bitcoin itself, many people don't like to call it risk asset, but it has historically traded closely with risk assets. They tend to have sort of divergences, and to me, like I think it's really impressive for one how Nvidia has sort of hung in with Bitcoin in terms of its gains. It's just a remarkable story in itself, and perhaps shows you how important that company is, or at least how important the market thinks that company is. Over the last 10 years in terms of its gains. But I mean, there are periods where Bitcoin is wildly overperforming equities, and there are periods where it sort of just chugs along, and that just is consistent with a developing, maturing market. I don't read too much into that, other than the fact that equities, in my view, have reached a lot of saturation points with respect to exposure, and part of that is also the passive flows. I mean, one of the reasons why people just stand back and they're consistently sort of confused by why does the stock market consistently go up? It's because the stock market has effectively become our nation's store of value. It's our preferred store of value for retirement accounts. There is a constant passive bid and flow, whereas that is not the same for Bitcoin. Yes, there are hodlers that will consistently buy in DCA into regular intervals, but the amount of relative money that's coming in is nothing compared to what happens in a bull market when you have everybody and their grandma piling into it and sending Bitcoin much higher in the short run. So that's more discretionary, short-term spending and spending and buying pressure that is fleeting. It's not as consistent as a passive bid in the equity market. So I think that's just basically my takeaway. I'd be interested in Tone's view though.
Tone?
Sorry, guys, I was doing something. I was just letting Joe speak, and I was talking about the ratio between like Bitcoin and Nvidia.
Yeah, it's basically a Bitcoin versus Nvidia chart, and like Bitcoin versus S&P, Bitcoin versus QQQ, like these ratio charts where you're able to kind of, how I see them, Tone, is like it was a while back, I think 2, 3 something years back, when I transitioned from Bitcoin to gold. And I know you do this quite often as well, where you transition from one asset to the other based on what you see. So how important are these charts? And on top of that, the current uncorrelation that we are, the current negative correlation that we are seeing between S&P or QQQ and or Nasdaq and Bitcoin. What do you take out from that? What do you see happening there?
Look, I just think that it's temporary. Basically, this negative correlation, because at the moment, Bitcoin is just too speculative with this whole Bitcoin ETF, and it's trading on its own. And during quiet times, Bitcoin will have a much higher correlation to the stock market because it's similar speculators that will speculate on S&P 500, and it's the same similar speculators that will speculate on Bitcoin. And if it's not an individual speculator, it's a bot written by that speculator, or automated trading written by that speculator, or some kind of an AI that reads news before a human does and executes trades. And that same mechanism will treat risk assets in a similar way. But when there is a shock in one of these systems, that kind of goes against the other. In this case, the Bitcoin ETF and the pressure and the selling and the news event is just overtaking Bitcoin. We're going to see something similar around the halving. I don't know if the halving event is going to cause a huge rise in the price of Bitcoin or a big pullback in the price of Bitcoin. I can argue for either one. If too many people buy into Bitcoin trying to pre-run the halving is going to be a sell the news event. If people are still scared and GBTC is still bleeding Bitcoin and Bitcoin continues to go down all the way till the halving for the next 3 months, I can certainly see the halving event being a huge bullish boom to the price of Bitcoin because there just won't be as much Bitcoin out there to buy after the halving. So it really depends how we get into the halving, and that's where Bitcoin just becomes an uncorrelated asset to the S&P. I'm not going to say it is negatively correlated because it feels that way at the moment, but it's just uncorrelated because of all the current situation in Bitcoin. Meanwhile, there could be other situations in the S&P when the banks were failing last year, when Silicon Valley Bank and Signature Bank, when those banks were failing and causing a little bit of panic in the traditional banking system with the stock market, Bitcoin was benefiting from that because everyone was screaming, well, you see, you should hold Bitcoin, you should hold Bitcoin. And I believe Bitcoin was rising while the S&P was falling because that kind of a shock to the traditional financial system was used as a bullish news as to why you should hold Bitcoin. So we're just in that short-term environment where Bitcoin becomes an uncorrelated asset, and it just happens to be negatively correlated by being uncorrelated on a short-term basis. That's kind of my view on it. As far as like using the ratio charts to trade, I think it's very challenging. I think it's something that could maybe be done on a longer-term trade basis, but not on anything short-term. For example, the gold-silver ratio, I believe, is going to go way past 200 in gold versus silver. But it won't happen until the prices of both of them start to go down, because I think gold is heading to 3,000 and silver is heading back to $50 at best. But then gold is going to fall maybe $500 and silver is going to fall 50%. And then you're going to see the gold-silver ratio spike to over 200, which is something that I'm expecting. But these are longer-term trends.
100%. Like, as I said, like these charts can be used for long-term investment decisions, like year-long or 6 months, 7 months, 8 months. You're basically talking time because you're transitioning from one asset to the other. There's a lot of things involved. It's not fiat currency that you're transitioning into. So yeah, guys, do look at those charts. It's fun. It's you find new things in there, but remember that. So moving on towards a little bit of not geopolitics, but inflation side of geopolitics. Tone, we are basically seeing another new type of inflation pressure which is coming in, which is basically building up in Suez Canal transit volume because it is continuing to go down. Right now it is kind of very low at this point of time. I think it is sitting at around what's this number? Let me try to get this chart onto the next as well, Tone, for you guys. But my point is, like, are we entering another phase of inflation with the SEC, with the Fed trying to get us down and all these geopolitical things happening? Are we entering another phase of inflationary cycle? You're muted.
I guess I'll go first. So yeah, this is similar to what happened during COVID with the lockdowns. I always said that the inflation that we saw rear its ugly head in like 2022 was more of the result of the lockdowns and the destruction of the supply chain than it was with the money printing that took place during the lockdown. And now I believe we are going to see more inflation because it costs more to move goods around Africa than through the Straits. So I think we are going to see more inflation that would put pressure on the Federal Reserve to continue to keep rate high. As I expected, there's not going to be any significant rate hikes, and the rate is going to stay on the higher side. I am very, very surprised how much the interest rate has come down in the 10-year yield. Maybe Joe has some comments on that. I'm a little bit surprised because I don't think the U.S. is that creditworthy. There's two reasons why the interest rate on government bonds rises, or is high. Let's just say high, not necessarily rises. Two reasons why that interest rate is high. One is underlying inflation, and investors in those bonds want to make sure that they at least cover what they would lose in inflation by holding that dollar amount. That's reason number one. Reason number two is the credit worthiness of those bonds. And while the United States is somewhat still credit worthy, I personally do not trust the credit worthiness of the United States or a Western country, or any country for that matter, that cannot live within its means. So any country that perpetually takes on a deficit cannot be trusted. And eventually, they will not be able to pay that bond. I have no idea when. It's always been later than sooner. But I don't believe the U.S. has that good of a credit rating for the interest rate on a 10-year yield to fall that much in the last, say, 6 months. But it fell. And I do expect it to go back up, especially if the United States does do the crazy and confiscate Russian assets that they have frozen for the last 2 years, because that would send a shock through the system, and other countries will look at the U.S. with more distrust, and that would force the U.S. to offer a higher yield on their bonds, even though the countries that distrust them aren't buying U.S. bonds already. These are being China, Russia, probably the Middle East is getting in on that, not buying the bonds. I mean, Iran obviously was never buying U.S. bonds, but the Global South, as it's called, probably does not trust the West at all. And the less buyers you have of your bonds, the higher the interest rate you have to offer. All right, I'll leave it here.
Joe, your comments?
Yeah. So I think you want to start with one thing that I think Tone may have alluded to, but I want to just pull it apart a little bit more, which is the bond trade. And one of the reasons why I think the bond trade has consistently had actually lower yields. You've seen lower yields for probably about 2 years now than you should have, has been effectively people front running the recession. You saw all of last year, despite a consistent, regular, mechanical sell-off of the long bond, investors were piling into those things like they could not buy enough. Just getting their faces ripped off, continuing to buy and grab a falling knife. It is kind of amazing, actually, if you look at some of the ETF flow data into things like TLT. Retail was just piling into that through all of last year. And, you got this bottom coincident with, the QRA, the quarterly refunding announcement that came. And I think it was really interesting because what we learned there, and that's when the stock market goes on this absolute rip higher, right, in bottoms at the end of October, was that supply really matters, that who's absorbing the long end paper really has an outsized impact on the market. So why is that significant? Well, in full disclosure, I mean, I'm just going to tell you, I am short long bonds. I'm short the futures, particularly on the 10-year, because I do think Tone is correct, and you do see yields go up higher. But the one ingredient you want to see in that is you want to see new supply come into the market. And as Bitcoiners, mostly in the room, you're really sensitive. We should be really sensitive to supply dynamics, and they matter quite a bit. When Janet Yellen decided to fund the government with a lot of short-term paper, and that was a sort of a welcome development by the market at the end of October, that led to this massive risk-on rally. And the question is, in a few weeks here, is she going to continue to fund the government with 2-year or shorter duration paper, or is she going to have to keep with historical norms and issue more coupons? And if she does issue more coupons, I think that sends long end rates much higher. That, combined with what I was alluding to earlier, which is the recession trade, which I know people can reasonably disagree on it. I know that there's plenty of data to suggest the economy is slowing, but I still believe we're quite a ways away, if not, a quarter, at least at a minimum quarters away from what could be a real significant recession in the United States, if you get one. Now, again, we can debate that, but I don't want to really go on that path right now. the point is that if you're all bared up and you're into a pre-recessionary trade on long bonds, which I know many fund managers that are, that's going to get unwound if long bonds continue to have higher yields, i.e. selling off. And I think you could, it's kind of not an expectation of the market, but you could see quite a repeat as to what we saw last year. Keep in mind, go back to 2022. In October of 2022, we had the 10-year peak in yields, and then you actually had it bid through most of the early part of 2023 before moving into the latter part of 2023 when we made new highs right around 5% on the 10-year. I would not be shocked at all if we see yet again a repeat this year because of funding dynamics with the government, where you are challenging the prior highs in yields in the latter part of this year. I know that's not, sort of a consensus trade at this point. Everybody thinks that the peak in yields is in. I challenge that, and I think there's plenty of data to suggest otherwise. And man, that you're going to make a lot of money on that trade if I am correct. So we'll see. Again, we're all just guessing here, but I believe that the supply demand dynamics matter a lot. And I think the economy is way too strong and inflation is too high for the yields to be at where they're currently at. They should be, in my view, at least 50 basis points higher at the 10-year. So, that's my general view on the trade. Now, on the bond trade. Now, with respect to the inflationary pressures, I can also sort of concur with the idea that you have this diminishing returns with respect to inflation. I think inflation clearly peaked. I don't expect to get anywhere near the CPI numbers you were seeing in 2022 and the early parts of 2023. But I do think that getting that last, 50 bips down to the 2% target is going to be really difficult, absent some sort of slowdown in fiscal spending, which I don't think is going to happen in an election year. So, to me, like you have to factor in there could be some exogenous event or something breaking that could cause a lot of fear. And if that happens, then bonds are going to get bid across the board because that's where money goes when it's scared. But absent that, you can make a very convincing case here that rates are far too low. And I also think there's plenty of evidence to suggest that some elements of the economy, particularly real estate, is seeing early signs of potential reacceleration, which also is, I would view that as bearish for bonds. So anyway, I'll stop with that.
Thank you. So moving on to Mr. Trump. Tone, there is a lot of things going on in Trump's world right now. Trump cards, Trump NFT, and all these things. Why is he doing all these things, Tone? Like, why try to? He's basically being speculative. To be honest, he's doing business while running for an election. Do you think this is ethical? Do you think this is the right way to approach things?
It depends. Like a lot of us Bitcoiners are not very political. We want to be, off the grid. We don't care to vote. We do crazy things like vote for libertarian candidates that have no chance of winning. And Trump might have some advisors that say, hey, if you do this NFT thing, you're going to have all of these 18 to 22-year-olds voting for you. The liberal 22 to 23-year-olds that think that, NFTs are the hottest things in the world. That could be reason number one. He's doing it, to get a specific vote. Reason number two is he doesn't understand what this is. And he has some advisors that are invested in some scammy projects. And Trump's not perfect. Trump had plenty of, close to him advisors in his presidency that wanted nothing good for him, and in fact did very, very bad things for him. So hopefully he learned from those lessons. That's reason number two. And look, this space is hard to navigate. Us pure Bitcoiners argue with each other all the time, even on things like ordinals. Like we can't even get along with each other on these types of issues. So how do we expect someone like Trump to really understand it? And I don't think anything of it. He doesn't really know better. And it all comes down to the advisors that you trust. And when you're surrounded by shitcoiners, which most politicians are, because shitcoiners gravitate to them like crazy to promote their scams, eventually these scams slip through the cracks.
Terence tried to come up to the stage and I accepted it. I'm not sure whether
Yeah, I
it
think
got
I'm here.
accepted or
Thank
not.
you.
Hey, welcome, man. Uh, any questions, anything that you want to add?
Yeah, just a quick comment. I agree with Tone, but I'd also add that I think Trump has always been good at making money sometimes, regardless of ethics or pumping and dumping on retail or his voters. So this is another opportunity for him to scam. I mean, for the president to offer great art to his fans.
True. Fake art or great art, I don't know how to comment on that, but I'm not sure. I'm honestly not sure what he's trying to do. So let's move on a little bit towards what to expect in the coming week. So more than 20 companies of S&P are going to come out with their earnings. Few of them very, very big. And we have a lot of things like we have the GDP numbers for Q4 2023 data to be forecasted at 2%. They are supposed to come out on January 25th. We have Grayscale Ethereum ETF deadline coming on the 25th of Jan. A lot of stuff is going to happen. What's one by one? What do you expect with the GDP numbers from the December uh, data? What do you think what we are going to see, and how do you think it's going to impact?
I think GDP, the GDP numbers for the US, I think they'll be in line. I think that, I mean, I haven't even looked at what the expectation is, but I'm pretty sure it's going to be close to in line. It's usually in line. I think the market will be fine. And also, I don't trust this current administration. They will find a way to fudge those numbers. I mean, they need to get reelected. So this is the 1 year where I'm expecting a beat, if not perfectly in line or a beat. I just don't see how this administration is going to allow an off GDP number going into the election, because I don't trust this administration. But politics aside, there was a good question on Twitter. In reply, P. Dilly asks, he agrees with us on the rates, but his question is, how will stocks, Bitcoin, and gold trade with higher interest rates? And I continue to stress this point over and over and over again. We just get muted by accident.
So I clicked by accident. Sorry about that.
So I continue to stress this over and over and over again. The interest rate when it comes to stocks, Bitcoin, and gold on a long-term basis is irrelevant. And I repeat, it's irrelevant. Now, the interest rate on the day that it's announced by the FOMC and the Fed, the market goes nuts. Okay? It matters for a 24-hour period. On a longer term basis, it doesn't matter. Say the interest rate is 1%, and you think the stock market is bullish, and the stock market will make 10%. Does it matter to you that obviously you're not going to invest in the fixed income market? You will borrow as much money as you can, or you just invest in the stock market. Let's say the interest rate is also 1%, but there was a bear market in stocks. Why would you borrow money at 1% if you think the stock market is going to lose you money? Now move the interest rate to 6%. Let's say the interest rate out there is 6%. You think over the next few years, the stock market is going to return double the 6%. You're going to borrow money at 6% and you're going to put it in the stock market, or you're just going to put your money in the stock market instead of the bond market. Okay. The interest rate, when it comes to the gold market, the speculative markets, it doesn't matter. The market adjusts. Okay. The market adjusts to wherever interest rate is happening. Now, on a short-term basis, it might matter. And if you are a big player like BlackRock and you're able to borrow cheap money from the Fed at 0.5%, yeah, it's great for you. But if BlackRock believes that the stock market is going to make 15%, they'll borrow at 5%. It doesn't matter if they're borrowing at 1% or they're borrowing at 5%. So to me, these interest rates, they matter more when it comes to comparing them or using them for speculative investments, they don't make that much of a dent. Now, when it comes to government reissuing their debt because they never pay the principal and they always just roll the interest, this is a huge problem for the government sector, but not so much for the private sector. It also affects, some entrepreneurs. They got to borrow money at a higher interest rates, or you're buying a house at a higher interest rate. So you just have to work harder and make a bigger business to pay off that interest rate. Okay, I'm going to leave it there.
Joe, can you hear me?
Yes, I can.
I can hear you as well.
Yes.
Go ahead.
Okay. So let's talk about the interest rates. I think it's a very confusing topic for many people. Let's start with there. What the relationship is between interest rates and equity markets in general. And I think what the fairest way to read it is that we don't really have an equity market as a whole. You have very different segments of the market, and you have dominance in the equity market through very, very strong companies. The Magnificent Seven and other portions of the S&P 500 are the dominant equity market that most people associate with. Now, why I distinguish on that is that I think you can see clearly in the data that different portions of the quote unquote equity market, most notably small caps, react very differently to higher interest rates than your mega caps, which are bulletproof from a balance sheet perspective. So to Tone's point, I don't believe that any of these higher interest rates, anything within 5 or even 6%, are going to make Apple somehow unprofitable, or Google, or any of these other companies that can basically print their own money. They have such balance sheet strength, and they have such dominance and moat. Calls. What I was saying is the mega caps have the ability in these moats in their industries where they're not interest rate sensitive. Now, that is not to say that there aren't companies, and Tone alluded to this, more entrepreneurial, smaller caps, portions of the Russell, portions of real estate that are extremely sensitive to interest rates, and you have to differentiate. And I think that's one of the reasons why the market was showing this preference for mega caps over the last couple of years, and the outsized influence of the mega caps in the indices, because the market recognized that they were less sensitive from an interest rate perspective than the small caps. So higher interest rates, I think, if you're talking about Bitcoin, I do think they played a significant role in collapsing some of the Ponzi economics of some of the shitcoin space in 2022. And I think they were a proximate cause, maybe not the only one, but one of the proximate causes for the collapse of FTX and some of the other crypto exchanges. Once you increased and had that shock and higher cost of capital, it rippled through those interest rate sensitive areas. So in my mind, you have to differentiate. But I think the larger question is what is the effect of these higher interest rates? And I think it's going to be disparate. It's going to be directly proportional to how sensitive you are from a balance sheet perspective to higher rates. And one final thing I will say is that everybody keeps trying to draw these analogies with 06 and 07 and these other periods where you had an interest rate shock, and then you had a cascade of delinquencies and bankruptcies and companies going under and people that were over leveraged. And I think you can make a convincing case now that many companies, including some of the high risk and high yield, are not as sensitive from an interest rate perspective as they were in prior periods. And you see this in the net interest cost as a percentage of corporate profits, which actually declined, meaning that it was not as expensive for companies as the Fed was engaging in a hiking cycle. There's a great chart that I've shared, I think, in these rooms a couple times, and you should look at that. It still is historically very low for companies to carry cost of capital, and there's many companies, including high yield, that have debt refinanced out for several years. So they continue to have some runway ahead of them. And all of that is to say, it's important because unless you have a massive wave of unemployment and bankruptcies and delinquencies coming, interest rates aren't particularly meaningful. You get really bad sell-offs in the equity market when you have a wave of unemployment rising, and that's just not in the data yet. Maybe it will come at some point, but it's not in the data now. So just my view.
Yeah, I just want to mention something to what Joe said. So also remember, if you are a startup and you need to borrow money, yes, the low interest rate environment is great, but that but you're also not part of the stock market, right? So that's different. And also, for all the good that you can do by borrowing cheap money as a startup within a low interest rate environment, there's also a chance that a bigger company can also borrow cheap money and buy you out or use that money to interfere with your business. Okay, so having a higher rate environment and your company able to survive will make another company think twice about borrowing money to acquire you, right? Because that money is going to cost them money. So the free market finds a way to balance it out. Now, if the interest rate goes out of whack, like what happened in 1980s to say 18%, now it starts to actually significantly challenge the annual stock market returns. But in general, when the interest rate hovers between say 2%, 1%, there are distortions. Once it gets to zero and negative, there are definitely distortions. But as the interest rate hovers between 2% and say even 7%, it makes very little difference on traditional speculative markets like gold, stocks, Bitcoin, or anything else.
Go on, Terence.
Yeah, so great points. To build on what Joe said about net outlays for private companies, we have the same pattern with federal net outlays. This is an unpopular opinion from the doomers and the Bitcoiners that often think that this will finally be the year that the US collapses. Federal net outlays as a percentage of GDP are pretty manageable and look manageable for the foreseeable future. We know that there's a debt that's rolling over and the government might have to borrow at much higher rates than in the past, but it looks manageable. I'll post something in the nest if that's okay. I just found the chart from the St. Louis Fed.
Cool. That's it from me, guys. All the topics that we had for today, perfectly covered, everything explained very well, given your thoughts as well. Any final thoughts from each one of our speakers? I think Joe has already dropped off. Tone, any final thoughts?
No, that's it, guys. Follow the Financial Summit YouTube channel. A new show started on that channel. It's myself and Matt McGregor of Alpha Numerics, where we talk about mostly the Bitcoin market every day. There'll be other shows launching on that YouTube channel. I will be a part of some of them, not all of them, where we're going to talk about more traditional markets and bring on other super interesting shows, including educational shows and economic shows. And check out the website.
We also have health shows, right?
Sorry, so say again. I didn't hear that.
I was saying we also have some health shows which we are planning for the YouTube channel.
Yeah, there'll be some finance and trader related shows having to do with health. We are going to combine the two topics, and more info on the in-person Financial Summit in the Maldives is coming very, very soon. You can already pre-register for that event, but the full registration will probably open in about a month, and that's coming in March of 2025.
Well, Tone, thanks for doing what I was supposed to do at the end. But thank you so much.
Oh, and the guys, go back to the beginning of this space where I talked about the price of Bitcoin. Even though I should probably mention it now with 500 listeners, I am looking for a potential low in the price at or between 36 and 38,000, ideally in line with the daily MRI buy coming in at the end of this week, which would be in line with the 1 to 4 weekly correction of the weekly MRI buy. There's a moving average there, the 128-day moving average around 36, 37,000. Also, the 38,000 is good support. So everything seems to coincide with a $36,000 to $38,000 zone at the end of this week. For me, that is the only place where I would consider catching the falling knife. Otherwise, I'm waiting for a breakout above 43,000 before turning my position back to 100% allocation bullish. Right now, I am still 75% cash personally that I exited the day before the ETFs came because I just was not comfortable holding at those highs going into the ETF announcement.
Well, thank you so much, Tone. Guys, if you haven't visited our website, do visit it, thefinancialsummit.com. The Financial Summit is an event. It happens yearly. Next event is going to be in March 2025. It's going to be in Maldives, and you can pre-register as Tone said. And well, if you do that, there might be some discount available. So go ahead, visit the website, and talk to you guys soon. Thank you, Tone. Thank you, Joe. Oh, Joe wants to come up. I think he has something to add. Go on, Joe. Joe, you are a speaker now if you want to add something.
No, sorry, I had to take a call, and sorry I missed the last couple of minutes. But is there another question, Penny?
No, any final thoughts, Joe? Any final thoughts before we close this one?
So the final thoughts I would say is that you have a strong bullish uptrend in the equity market. I think you have stronger economic data than many were anticipating. So I don't see something that should cause you to run for the hills and panic in the short term. Now, that is not to say we can't be in for a longer period of consolidation. And as I've learned from being in Bitcoin for many years now, I don't ever nail the bottom. I always sort of buy near the bottom or slightly above the bottom, and that's fine. And I think it's a good time to deploy capital in the next few weeks here. You're going to get some good opportunities, and that's great, right? It's great, I don't know, what are we 90 days out from the halving, somewhere thereabouts, a little less. To me, if you were looking to allocate, you'll get a few good opportunities in the next several weeks here, and that's great. And I think what you really want to look at, and I think what other smart, savvy traders reading the market are going to look at, is when do the outflows from GBTC finally start to abate? And I think that happens. It may come faster than we expect, maybe in the next week or so. And once that starts to abate, nobody wants to be sold into. I expect a reaction very quickly back to probably the 41, 42 range.
Thank you, Joe. Thank you so much. Thanks a lot, guys. Thanks for joining, and thanks a lot to all our speakers for coming up and giving their time. Looking forward to talk to you guys next week. This week, but closer to the end of the week. So yeah, thanks a lot, guys. Take care.